All right, and again, good afternoon, everyone. Welcome to today's webinar, Succession Planning, How to Engage Members in Their Future. My name is Brian Munson. I am the Business Development and Sales Manager for NCBA CLUSA. I will be today's webinar moderator, and the webinar today is co-hosted by Castle Wealth Advisors and Project Equity. But before we begin, a quick bit of housekeeping for everybody that's on the line. You'll notice that your phone line is muted during the presentation to reduce background noise. If you do want to pose a question, you can of course do so, just not verbally. You've got a question box on your GoToWebinar control panel. You can simply enter it there, and once we reach the question portion of the presentation, we'll be sure to collect all those and get them answered as time allows. As I mentioned, or I haven't mentioned yet, but NCBA CLUSA is recording this program, so it will be archived on our website. You'll receive an email with that link to the recording tomorrow, and we'll look to get it up on our website within the next week or so. Please feel free to share it, pass it along to colleagues, some of your members, whoever you think would find value in it. We encourage you to share it. So with that being said, again, my name is Brian Munson with NCBA CLUSA. Today's panelists, the important people, are Gary Pittsford, CEO of Castle Wealth Advisors, and Allison Lingane of Project Equity. Just a quick bit about Gary. He's a certified financial planner, has over 3 decades of comprehensive fee-only financial advisory experience. He's a featured speaker at many a purchasing co-op and industry-specific conventions. He's a writer too. He just recently published a book, Your Family Business, Your Family Net Worth. It brings together all of his best practices. He and the team there at Castle Wealth are experts. They design and implement financial strategies for closely held business owners. We've worked with Gary and the team for a very long time. He's got a lot of clients amongst our members, so we always appreciate his insight and his collaborative nature. Allison, she started her career in community-based work, designing and leading micro-enterprise programs for urban youth. Prior to launching Project Equity, Allison actually spent 15 years in executive roles at mission-driven companies. She has her BA from Harvard and her MBA from the Haas School of Business. She's a 2014 Echoing Green Fellow, so she's very smart, very driven. We appreciate her energy. She's relatively new to us at NCBA. She's been working with the National Cooperative Bank, helping purchasing co-op members transition their businesses to worker-owned entities. And her and her group at Project Equity are quickly becoming a go-to resource for our members at NCBA CLUSA. So we appreciate both these folks for joining us today. Before we quickly get to the presentations, just a brief bit about the agenda. Gary and Allison will run through these 3 items today, and the focus is really how to protect the co-op. The folks on the line today are executives at purchasing cooperatives, and this webinar is geared towards you. You'll learn today why the business case for succession planning is essential to get members engaged. So if you didn't know what the business case was, hopefully by the end of today you will. Following that, they'll dive into how to market the business case to your members, trying to discover the why rationale all the way into the how-to implementation, as both are very important. Lastly, Gary and Allison will examine the options available to your members, what could be a good fit for them, some of the better do's and don'ts, and from there we'll look to talk a little bit about part 2 and part 3. Those parts of this webinar series will be focused on your members, so we encourage you after this webinar, let them know, hey, I attended this, it was awesome, part 2 and part 3 are coming up. We recommend that you attend. So with that said, I'm going to be quiet. I'm going to turn it over to Gary and Allison, and we can get started. Gary?
Thank you, Brian. Thank you. Hi, everyone. I appreciate you taking time to listen in. Let me start by emphasizing what Brian said, that this is everything that Alice and I are going to talk about is different ideas and different ways that the co-op directors and co-op presidents can help educate their members in order to help keep their members. There's a huge percentage of members in the different co-ops that are between 60 and 70 or between 55 and 70. And all of them are going to be wanting to figure out how to move towards retirement or how to slow down, how to work less, how to sell it, how to sell the company. All of you have members who have worked 30 or 40 years to build up the company. But now when it comes time to maybe back out and sell or transition, they're not sure how to do it. And what we want to do is to talk about the things that we're doing with lots of co-ops. We work with a lot of co-ops that have 200 to 500 members. And then we work with quite a few co-ops that have, more than 2,000 or 3,000 members. And in all the things that we're learning and that we're doing for all these different people, I wanted to try and pass on so that we can help you come up with some ideas in order to protect your membership. So if you've got 200 members or 2,000 members, let's talk the next 45 minutes or so about things that you can think about on how to retain membership, how to stop the attrition of members. Because if you've got 500 members, I don't want you to, at the end of the year, to have 450. I want you to have as many members, and I want your organizations to grow. So on this first slide, reduce attrition is what a lot of co-op presidents are talking to me about, and Allison, and we're trying to figure out ways to help the members. The more we educate them, the more options that they know they have, because a lot of business owners, no matter what the business is, whether it's a hardware store or a carpet store or a grocery store or a roofing store or whatever it might be, a lot of them don't know what their options are. So if we can educate them, we can let them know that there are choices. So number one, educate the members is always important. One of the problems that many co-ops have, and many business owners, the first option there is realistic valuations. We'll do here, I have 4 different companies, and one of them is Castle Valuation Group, and we'll do about 80 to 100 valuations each year. And quite often, somebody will tell me that he thinks his company's worth $2 million. And when I look at 3 or 4 years tax returns and 3 or 4 years financial statements, we'll do a valuation for their industry based on industry standards. And I'll have to go back and tell him, well, it's not worth $2 million, it's worth about 850,000, and it always takes the wind out of their sails. But they need to know what it's really worth, because if they try and sell it for $2 million, they're not going to find any buyers. So realistic understanding of business values and what it's really worth is an important thing to talk about. Different avenues for selling. Normally, I've learned over the last 40 years that about 25 to 30% of the owners will sell to their children because the children work there and they want the business. That's one avenue. A second avenue is to sell it to 2 or 3 or 1 or 2 key managers that work at the company. The kids picked a different profession, but the key managers have been there for 10, 15 years and they're capable of owning it. That's number 2. Number 3 would be selling it to another co-op member, and that's where the co-op presidents can provide a lot of input, helping to keep track of who the buyers are and who the sellers are within your organization. So selling it to another co-op member. And then later in the next few minutes, Allison's going to talk more about a worker co-op maybe buying out the owner, or an ESOP buying out the owner. So there's 4 or 5 different ways that owners can sell. We just need to sit down and talk to them and explain the ideas and find out more about what their choices are and what fits. What to do if they're approached by a non-co-op member. This is where the co-op and people like Allison and us can help educate the members to know whether it's a good choice or not. We'll talk more about roll-ups. Some groups and some of the co-ops are gobbling up other smaller members. I'd say maybe 50% of the time that might be okay, but the other 50% of the time it blows up, it doesn't work. So people need to know the pros and cons of every one of these ideas. Planning for succession, most owners don't plan ahead. And the speeches that we try to give, we try to tell members, here's a 3-year plan. I try and encourage people to think about retiring 3 years from now. So this is 2017. So if you really want to retire in 2020, you really need to start planning today. If you try and sell it, if you try and sell your business in the next 3 to 6 months, I guarantee you that 2 things will happen. You can tell your members that you won't get the best price if you sell it quick, and you're going to pay maximum taxes. So, but if you give yourself some time, if you put together a team of advisors, and if you work at it for 2 or 3 years, you'll get a better price and pay less taxes. So those are the things that really are important when it comes to succession planning. And then we need to let them know how to get started. What should they be doing? This is in my book. I talked about, I do 20 or 25 speeches a year. And a lot of people will come up to me after the speech and they'll say, Gary, we don't know where to start. We don't know what is step 1. So helping to educate the members about plan over 3 to 5 years. Here is the first step. Here's your choices. So educating the members in all these different ideas is important for the co-op. And there's a lot of ways to do it. We can talk more about this later. The articles that we write, that Allison writes, videos, speeches. There's, working with, if you have a field staff, if you have district managers, educating the field staff that's out talking to the members. There's a lot of different ways of educating the members. We do a lot of special videos for some of the larger co-ops. Number 2, and I'm talking too much, Allison, I'm sorry, encourage the next generation. A lot of the co-ops want to educate the children who are going to be taking over. So anything that we can do to encourage the next generation to take over is always good. One of the things that I did, a few months ago, out of the last 500 valuations that we've done, I went back and looked at what was the EBITDA to the appraised value. And it's about 23%. And this is on 4 or 5 different industries averaged together. So it's not one specific industry. So I could tell the next generation that, yeah, you could go to work for Apple or Google or someplace, but if you go to work at this family held business, your cash flow could be about 23% of appraised value. And your cash flow, which is EBITDA, would be about 36% of stockholders' equity. So there's a lot of value in a family held business. And if you studied your MBA or a BS in finance, you can figure out how to take this company that your dad built and grow it and leverage it. And if somebody told me that I could make a 23% return on appraised value or 36% on stockholders' equity, that's a hell of a, that's the company I want to buy. So unfortunately, the next generation, they don't get to see the good side of the family business. They always get to unload the truck and drive the forklift. So they don't get to see the good side. They get to see the bad side. But we want to try and educate the next generation so that they'll be tickled to death to take over an ongoing successful company. Number 3 is to protect, as we said in the beginning, protect the cooperative. How are we going to help keep the member head count up, keep your income up, increase the membership numbers, and keep them financially strong? And if all your members are financially strong, then that makes your co-op stronger. So all these things that we're glad to help, this is what we do for all the people that we normally work with. And if you have questions, get them to Brian at the end of this session. But Brian, let's go to the next page and we'll try and speed up.
So yeah, Gary, I'll jump in here. And, the real challenge, it's clear that the succession planning is important. And as we know, the real challenge is everyone is so darn busy. So, how do you fit it in, and how do you have the message heard? Retirement doesn't feel urgent in the day-to-day, and so we really recommend that you weave the communication about succession planning into your other communications. Because if it's a standalone thing, it's very easy for business owners to either set it aside and say, oh, I'll look at that later, or just ignore it. Oh, that doesn't apply to me because I'm not in succession planning mode right now. So we really recommend that you first think about what communication channels you already have. You're sending newsletters, maybe you're sending surveys, maybe you do webinars or in-person classroom sessions, and of course your member meetings. And then think about the ways to weave in the messaging about the importance of succession planning, about the options into those different communication channels. And do it in a way that both shares the sort of cut and dry, the how-to and the data, the information, with the stories, the real people, the anecdotes. Because those stories are the things that stick in our brain and remind us about the dry data and how-to stuff. So combining both of those is going to be really important. So Gary, back to you.
Educating everybody based on those things that you see there are important. We talked about the field staff, and I've learned over time that it's really a multi-year process. The last 3 to 4 years, one of the things that we've started doing is the one-on-one meetings. Members at a convention, if we spend an hour with each person, they really love that one-on-one private meeting, and that really gives them something important to take home. And I've also learned that it takes more than 1 year. We've had people attend 3 and 4 classes over 3 or 4 different conventions. And then they come up to me and say, Gary, I've been listening to you for 3 years, and I finally think I'm beginning to understand what you're talking about. So it's kind of complicated, and a lot of members just don't get it the first time that they hear it. So when you start this education process with your members, just think that it's going to be at least a 3 or 4 year process or more. Depends on how many members you have, but it's impossible to do it in just 1 convention or 2. Your members are going to need a lot of hand-holding over the next few years to make sure that as they design a succession plan, it fits them and that they've got the right team helping them put it together. It just takes time. It's brand new to them. Brian, what's next? This was an interesting quick that Allison put together, but understanding the key points and the options, and I thought she did a great job. The presidents of the different co-ops would appreciate closing down a store. Once in a while, a co-op officer will tell me that somebody closed down. They just found out that they turned the lights out and left. We call it going dark. But closing down a company should be the ultimately last resort. A business that's got customers, it's got a traditional 5 or 10 years of cash flow that they can report. There's usually, hopefully, a buyer that we can find for that business. So shutting it down is the last resort. They completely lose all of the enterprise value. We use the word enterprise value because that includes the goodwill, the profitability, the ongoing customer list, the relationship with the community. The whole enterprise is lost. So that's not good. It's not good for them. It's not good for the co-op. The next one is an acquisition. If it's an outside, if we have a roll-up company or a merger and acquisition company that's buying people, that's not good for the co-op. You're going to lose some sales. You're going to lose a member. So if it's selling outside the co-op, that's not good. We want to try and educate the members of all the other options that would help the co-op and help the member But acquisitions by a merger and acquisition company or a roll-up company is not a good idea for the co-ops. And the other thing is that a lot of the merger people, they talk about all stock, and I never would recommend all stock. Sometimes some of these situations, and I've been involved in several in the logistics warehousing industry, and sometimes these things don't work very well. A lot of times they blow up, it doesn't get done. They try to make it real big, then they can go to Wall Street and go public, and it doesn't work. So if somebody approaches a member and they offer him all stock in this new merger company, it's not normally a good idea. I would never recommend that. And then selling to family, that's a big green check mark. It's a good long-term plan. A lot of co-ops have families that have been with them for 3 and 4 and 5 generations. I'm working with one family right now, which the 6th generation is selling to the 7th generation, which is that's a long time. That's an old business. So keeping it in the family is a good idea. Selling it to another member is a good idea, and we want to talk about why those are good ideas for the member and for the co-op. And then Allison's going to talk more about ESOPs and worker co-ops a little bit later. But those are good ideas, and they're good for the co-op. And if they're done right, it's good for the company. But you got to be real careful, and Allison will talk about the pros and cons of making those things work. So that's kind of a checklist of ideas that that the president's listening in can use. I hope it's helpful. Allison, I appreciate your making it quick for everybody. What's the next page, Brian? Well, we talked about closing down. I already covered that. But as I said before, going dark and closing the company is really the last resort, and it's too bad. I hate to see that happen. If they're close to a major metropolitan area, there should be another co-op member. But sometimes I have a real hard time finding a buyer for someone, and I'm not in the finding a buyer. I'm not in the brokerage business, but trying to help a member. If he's in the middle of Wyoming or in the middle of New Mexico, we may have a hard time finding a buyer, but we want to try our very best. And the co-ops also try very hard to always find a member that's 50 or 100 miles away. But we don't want to lose that value. We don't want to lose that customer base, and it is the very last resort. So if they're educated about what their options are, I hope that we can always find a successful answer for every member for every co-op. So closing down is the last resort. What's the next one, Brian? Acquisitions. We talked about that briefly. We've been involved with members, business owners that in several different industries where there's roll-ups, mergers, big companies gobbling up little companies. It's not good for the co-op, and it may not be good for the member. And if we know the member, if we're working with the member, we analyze those things very carefully. And I would say over 50% of the time, it doesn't work. It's not a good idea. There are ways that if the member insists on doing such a thing, there's ways to protect the member, but the acquisition is hopefully something that we can encourage members not to go after. Get bought up by a big company with all kinds of great ideas about owning stock and going public and being a part of a big company. It doesn't work more than half the time. The impact on employees, usually if there's a roll-up like that, there'll be several employees that will be terminated immediately, because the big roll-ups, they want to eliminate as many employees as possible because they need that cash to drop to the bottom line to make the EBITDA bigger. And the last item, as I said, a lot of these don't work. And so we don't have to, but we should educate the members on the pros and cons of any acquisitions from a roll-up company, and why it's not always a great idea. So it's back to education again. Brian, what's next?
Yeah, before we switch to the next one, I just want to jump in quickly on the acquisition front. So we've heard from, depending on the industry, the acquisition pressure from outside buyers can be really intense in some industries. And those of you in purchasing co-ops that are living and breathing that, know what I'm talking about. And in those industries where you may have the big box acquirer or the public company that is cash rich and really needs to demonstrate growth through acquisition, what we've heard is that the challenge can often be that those big box buyers will come in and approach a member company, and the first thing they do is they slap down an NDA, a non-disclosure agreement for that business owner to sign. And if the business owner, is maybe doesn't have experience with non-disclosure agreements, can often interpret that as meaning, oh, I can't talk to anybody about anything. I can't talk to my purchasing co-op CEO to get advice or input. I can't look at other options for selling. If I sign this NDA, it means I'm committing to the deal, and my mouth is just shut. I can't talk to anyone. So that's one of the areas, if you are in an industry with a lot of outside acquisition pressure, to educate your business owners about, what are things to look for in an NDA, and to get legal advice about what it means and what it doesn't mean.
That's right, Allison. That's a great point. Once again, it's back to educating the members what that non-disclosure means, and they need to be able to talk to the co-op presidents or their regional or district managers or whoever they're working with. Anything else, Allison?
No, I think we're on to the next slide, Brian.
Yeah. Selling to the family. What Allison and I and Brian talked about was just giving you a quick example. We'll do, I don't know, we'll be involved in a couple of hundred succession plans each year. And so a bunch of them are to the children. Sometimes the son buys out the parents. Sometimes it's a daughter. Sometimes it's two children. Interestingly enough, quite often it's like the son and the son-in-law are buying out the parents. So we have a family member and an in-law involved. So there's all kinds of ways that family will buy out the parents. And very quickly, here's a typical discussion. The children wouldn't have a down payment. They don't have a whole lot of money saved up. So we have to design this thing so that there's no down payment. And usually we'll have to value the company, and then based on the valuation, the parents can gift some stock to the children. Usually they'll gift about 20 to 30% of the company. So let's say the children have 30% and mom and dad have 70%. So I usually tell most people that after a while, when you're positive that the children can run every aspect of the business, then they can either go to a bank and get an SBA loan and buy the other 70%, or they can sign a promissory note with the parents and pay them over time. Some parents want all cash up front. Some parents say, well, just sign the note and pay me over time. Every family is a little different, so we want them to have either option. And then the thing about the next is consulting fees, board of directors fees, non-competition agreements. It's a way of the parents to get some continued income. So after they've sold the company, they've sold the stock. After they've sold the stock or gifted it, they could still get some consulting fees. They can still be on the board of directors. Sometimes if they own the building and they're selling the business, we can increase the rent for the next 5 or 10 years, and the parents will get some extra income by having higher rent. And then there's some other benefits, like if the son wants to talk to his parents, his dad or mom, the company can pay for cell phones because they want to be able to talk back and forth. And maybe we keep the parents on the health insurance plan for a few more years. So there's some other corporate benefits that can be available. So mom and dad wind up getting extra money. So if they didn't get it up front, we usually can design it so that they'll get it over the next 2 or 3 years. So this is a typical way of getting the children some stock. The parents would still get their salary for 2 or 3 years. The children can take over. You know, I won't get into a lot of other documents, but there's a lot of documents like a stock redemption or a buy-sell agreement that is very important. And when we teach classes, we talk about all the things that when the children become stockholders, there's a lot of things that need to be done, talking about wills and trusts and stock redemptions. But this is a typical transfer some stock, sell some stock, get some continued income, increase the rent if they own the building. But that would be typical of a lot of families. There's always variations, but this is a good sample of how children can buy out mom and dad. What's the next one, Brian? Thank you. Sell to another co-op member. So let's say the children picked a different career and the key employees just aren't capable of running the whole company. They're great at running their certain division of the company, but they can't take over the whole thing. So the next choice would be sell to another co-op member. So there may be somebody that's 5, 10, or 15 miles away. Maybe they've got 1 or 2 stores and they'd like to have another store, and we try and get the 2 co-op members together. And as Allison said, the non-disclosure or confidentiality letter is an important thing and we help members with those letters. We'll help them design a plan and what it would look like, a letter that would go to the buyer. Usually we would need evaluation. We got to figure out the seller, he always says, well, I'm not sure what the company is worth, you know, so having the valuation is important, and it also helps us tremendously in the selling process, because by having all the financials ahead of time, we can answer a lot of questions and we can talk about what is the assets, what is the EBITDA, what is the cash flow. So knowing all of that ahead of time helps the selling process. Usually it's all cash, you know, so if my business is worth $800,000 or $2 million, the buyer usually would pay cash. The other thing that is important is the next item is that if one co-op member is buying another co-op member, they're going to buy assets. They're going to buy all the inventory and accounts receivable and the furniture and the employees, and they're going to buy all the assets. They're not going to buy my C Corp stock or my sub S stock. If I sell to my children or my employees, they will usually buy my stock. But if I'm selling to another co-op member, they won't. They're not going to buy stock. So the owner has to be thinking about selling all of the assets, not the stock. Sometimes a consulting fee is important. Sometimes the buyer wants to keep the seller around for a year or so to help with the transition, so there could be some consulting fees. And then the other item is that if the seller is going to sell the business but retain the real estate, then there would be part of the negotiations would be what is a fair rent and what goes into the triple net lease. And I'm sure all of you know what a triple net lease is. So it's mostly all cash, but every company is a little different, and the seller needs to be thinking about selling assets and what assets are going to be sold. And some of the co-ops have member patronage stock, preferred stock. So if one member is selling to another member, they normally would not sell their cash that's in the checking account. They're going to keep all their cash, and they will keep their stock in the co-op. And most co-ops will buy back that stock over 4 to 5 years. There's usually a staged payout. So those are 2 assets that are not sold. We don't sell the cash. We don't sell the co-op stock. Usually the person that has it will keep it. So that's typical of one member buying out another member. And I hope that a lot of you have members that have 2 or 3 stores and they're growing. Some co-op members have 15 or 20 stores, and they want to grow and get bigger. You know, so those bigger companies are great candidates to buy some of these smaller companies that want to retire. So we just got to educate people and get them together, get the big guys in the co-op look at the little guys and introduce them back and forth. That's becoming more and more popular because there's a lot of older members that are 65, 70, even 80 years old, and they would like to sell, but they're not sure who to sell to. So we want to help them with that process. Brian, what's next?
Okay, so
Allison.
Yeah, so I'll take over here talking about employee ownership. So employee ownership transitions, that's what Project Equity does. That's our focus, and that's our expertise. And so, you know, we've run down the options. And so if in terms of keeping member businesses in the co-op, selling to a family member is number one. And if there's not a family ready to take over, number two is selling to another member within the co-op. And then if that's not an option, well, number three, the reality is that all companies have potential buyers right there under their noses in the form of their employees. And so, you know, this is the form of succession or transition that I think is probably least well understood. And employee ownership transitions can be accomplished in several ways. And we're going to be talking about ESOPs and worker cooperative transitions in a bit of detail. There are also trusts, and there are other structures that can be utilized. You know, employee ownership is really a great way to anchor a business locally for the long term. You know, and as purchasing co-ops, many of you have as part of your mission, the keeping independent businesses independently owned. And so one thing to really know about employee ownership is it does require investment in the people side of things. And so this is in two ways. It's both in the leadership succession. So if your owner is retiring and they're the general manager or the CEO, you either need to have leadership coming up from within, or you need to actually do a search to find a new executive. But ultimately, it's really a path that's good for the employees and for the seller, both for continuity of operation and for legacy, as well as good for the purchasing co-op. So I often start a conversation about employee ownership with a graphic similar to what we've got up here on the screen now. And in the context of purchasing co-ops, it can be even more helpful because we already know what cooperatives are, right? Their business is owned and governed by their members. So a purchasing co-op is a business owned and governed by the member companies. And a worker-owned cooperative is a business owned and governed by its workers, so its member workers. And so a worker-owned cooperative is a form of employee ownership, and its structure should be familiar to those in purchasing co-ops. So the other forms of employee ownership, many are familiar with ESOPs, which stands for Employee Stock Ownership Plan. And in an ESOP, the way this works is that it's all or a portion of the company's shares are held in a trust on behalf of the employees. And ultimately, that is a retirement benefit. So we'll be going into both worker co-ops and ESOPs in a bit more detail. So next slide, please, if you could, Brian. Okay, so digging into worker cooperatives here. So again, it's a business owned and governed by and for the benefit of its workers. And in a worker cooperative, it's important to know that 100% of the business is owned by the employees. And the board of directors is made up of a majority of employees, a majority of worker owners. And the full base, so if you've got a 100-person company, and if all of them are worker owners, usually you've got some who are transitioning in to become owners, but if we say all of them worker owners, and that full base of worker owners is going to elect the board of directors, and let's say you've got a 7-person board or a 5-person board, the majority of that board is made up of the employee owners. So this is a high employee engagement structure given the governance role and the all-member voting for the board. And there may be other strategic decisions that all members vote on as well. So it's in a worker cooperative, profits are earned by the employees based upon hours worked. So it's called patronage, same as in a purchasing co-op. And strategic decision making is democratic, but it's a representative democracy through the board of directors. And it's a worker cooperative can be a fairly flexible business form. Many states have a corporation structure, a cooperative corporation. Not all do. An LLC is also a common business structure that is utilized. And there are potentially significant federal tax benefits. So to the seller, there can be potential from the sale, there can be potential lifetime deferral of capital gains tax through what's called the 1042 exchange. So in a C Corp, the seller can reinvest the proceeds of the sale in other securities and defer tax on the gain. And then tax benefits to the business once it's a co-op is avoiding double taxation on the patronage dividends, which are the profits shared with the worker owners. And that's whether or not those are allocated and paid out or allocated and retained in the business. So we often get asked how this is financed, similar to what Gary was talking about the, selling to family. It's not that the employees come with all of the cash. Typically, they come with under 10% of the total sale price through what's called their buy-in. And the rest is financed, a combination of loans. The selling owner can hold a note. It can do bank loans or with community development financial institutions or CDFIs. And so really the first step in this is, in terms of assessing if this is a fit, is a financial feasibility. And the way this conceptually works is that the future profits of the business buy the business from the selling owner. And so once the financial feasibility green light is there, the next step is to assess interest among a core group of employees who would lead the effort to acquire the business. So just high level of a worker co-op transition. So let's go to the next slide and talk about employee stock ownership plans. Okay, so ESOPs are retirement plans, again, that hold all or a portion of the company's shares in a trust on behalf of the employee. And so compare this to a worker cooperative, where a worker co-op is 100% ownership. ESOPs can be a small portion of employee ownership all the way up to 100%. They are highly regulated under ERISA and through Department of Labor, and this is due to the potentially significant tax breaks. So because of this regulation, there can be fairly high setup costs and ongoing costs. Some estimates are, sometimes it can be $40,000 to $50,000 to set up and $20,000 or $30,000 ongoing a year. So because of that, you really need to start with okay, well, is it worth it financially? And oftentimes, it's out of range for smaller companies, so 20 to 30-ish employees, or some use a benchmark of $1 million in payroll, but that's not necessarily a hard and fast number. So again, potentially significant federal tax benefits, the same as I talked about with the worker co-op, the potential lifetime deferral of the capital gains tax through the 1042 exchange. If it's a C corporation, and you can actually transition from an S corp to a C corp right before the sale in order to accomplish that. And to the business itself, if it's an S corp, the business doesn't pay income tax on the percent of ownership held by the ESOPs. So if it's 100% ESOP, there's no corporate income tax, which is pretty significant tax benefit to the business and therefore to its employee owners. So it's really important to note that the benefits employee ownership that research has demonstrated, so improved in company performance, improved employee well-being, these are really correlated, or they require participatory culture and are deepened by 100% employee ownership. So if you just have a 30% ESOP and you have no employee participation, you're not going to get that, the improved company, the improved business performance. Okay. And so what you really want to do in terms of having that strong employee-owned company is you want to have as close to 100% ownership as you can and really have participatory management or even democratic governance. So if we can go to the next slide, I want to just talk briefly about what we call a democratic ESOP. The democratic ESOP combines the tax benefits of an ESOP. So for companies that are big enough and for whom that financial feasibility really shows that the tax benefits of an ESOP make it worth it, with the structure, built-in structure engagement of employees that really bring the power of employee ownership to the strength of the enterprise. So it combines ESOPs with, we recommend built-in profit sharing, 100% ESOP, and it layers on a governance role for employees. Also, employees can participate in electing plan trustees and on trustee committees as another way to really be engaged, deeply engaged at a strategic level in the business. So hopefully this chart is helpful to understand some of the similarities and differences among these different employee ownership forms. But the important thing to remember is you've got those employees right under your nose, and so don't be shy about reaching out to organizations that do understand the succession option as a way to help educate your member companies that this is and can be a very viable path for them to take. Okay, so we've made it through talking about all of these 5 succession options in detail, and I'm going to now pass it back to Gary to help us summarize.
Thanks, Allison. I'm hoping that we're going to get some questions here in the next few minutes. This next slide, if you go to the next one, Brian, it is somewhat like what we've seen before. I was going to talk about the top 2 or 3, and then Allison, you were going to cover the bottom ones. But as we said before, when it comes to what you need to know, we've got to try and convince the members that closing down and going dark is the absolute last idea. We need to somehow work with those members and see if we can't find within the co-op a buyer. Acquisitions may or may not work. They're not my first choice, and they're always made to sound great, but the buyer has got to be very careful. They got to do a lot of due diligence, but the problem is they don't know how to do the due diligence. They've never been through it before. We talked about selling to another member, and I hope that for a lot of the co-ops that we work with, we can talk more about this in a little bit later. Some of the bigger co-ops are assigning 2 or 3 of their senior staff to stay on top of these things, and we'll go into that in a few minutes. But Allison, you had some comments about the ESOP and the worker co-op?
Yeah, and I don't think I have a ton to add at this point, and I just I'm looking at the time and want to make sure we do have an opportunity to take any questions. So why don't we wrap it there and turn it back to Brian so that we can use our last few minutes on that front.
Great, thank you guys. So there's a lot actually, here that you guys have gone over, and I do have sort of a couple questions we can walk through, but just very quickly, at the completion of this series that we'll be doing, parts 1, 2, and 3, we're working to create sort of a best practices handout on succession planning that'll be available to anybody that's registered for one of these webinars. We'll have it available at the conference, the Purchasing Co-op Conference here in Washington, D.C. So, all this information, and Gary and Allison will hopefully be joining us in D.C. for that conference. So if you have any questions, face-to-face, you have an opportunity to answer them, get them answered there. But, with the density of this information, we wanted to break it out to the second part, acquisition and selling to the family, probably sometime in late spring, and then selling to another member and employee ownership during the summer. So that'll give us a chance to, chat with your members, for the folks that are on the line, kind of hear what some of their concerns are, really develop this sort of best practices pamphlet, e-publication kind of thing, and be able to turn that back to you in October And again, I stress that Gary and Allison are both incredibly good at what they do, and we're very grateful to have them on board. So with that being said, in terms of these questions, please feel free to type them in the question box there. I have one. I have a couple, like I said, to kind of get us started. In terms of, and this could be for Gary or Allison, in terms of the family taking over the business, it seems like that was definitely a normal thing to happen, in maybe in previous generations. Do you still see a lot of movement in this area where the families are taking over, or the families are buying out the business, and those types of transitions, or is that, or some of the other transition opportunities, selling to members, or the worker transitions, are they more prevalent?
Allison, you start.
Yeah, well, why don't I just start with some national stats on that, and then some anecdotes, and then Gary, you can touch on your experience, especially within purchasing cooperatives. So we have seen nationally that there are fewer family members taking over the businesses. It used to be that I think 25 or 30% of businesses made it to the second generation, and that number is down to about 15% from a study the SBA did, gosh, about 10 years ago, so maybe even less now. And when you're talking about going to the third generation, the number is about 5%. So very, very small numbers in terms of businesses staying in the family. And I think we do also see some differences. I don't have stats on this, but just anecdotally, depending on where the business is located, if the kids have lots of other options, or not, in terms of rural versus urban centers, or considerations like that.
Interesting.
So good.
I agree with everything that Allison said. It seems like 40 years ago, when I started doing this, that a lot of the children naturally were working in the company, but career paths and different kinds of careers are being picked by the children to go into. They want to get a college degree and move to the big city. They want to go into something else. Sometimes the children don't appreciate the value of the business because they weren't really given a chance to see the good side. They always saw the bad side. So part of it is they have other career choices now. Part of it is because the parents didn't do a great job of teaching the next generation about the good parts. So to answer your question, that I think it is down, but I think it could be increased if we can convince the parents to let the kids see the good part of owning a business, how to build your net worth, be responsible for your own net worth and your own destiny rather than waiting for some company to give you a promotion.
That seems...
so being... Yeah, go ahead, Brian.
No, I was just going to say, you're sort of answering my follow-up question in terms of, what's sort of the co-op's responsibility then, or how does the co-op communicate, that kind of thing to its member, about how to talk to its next generation. So I think those are really good points that you're making there, Gary.
Well, what I would encourage co-ops to do is to, and several of them already have a next generation division. When they have a national convention, they'll have a next generation meeting, maybe a speaker to talk to the next generation. The important thing to me is to get a bunch of the 30 and 40-year-olds into a room and let them talk to each other about ideas that they're using and what works here and what works there. And by sharing ideas, it gets them excited. But getting the next generation together at a convention is a good idea. Having special articles or special newsletters for the next generation is a good idea. Mm-hmm. The parents, and I don't know if I'm somebody may throw rocks at me, but when I'm in a crude way, the parents are not good teachers. What I usually tell a lot of people is that the father's been the quarterback for the last 30 years, and he's been out on the field calling every play. And what I try and I've written some articles about this in the past, I try and tell the parents, the father, I say, now what I need you to do is to become a coach. I need you to move to the sideline, and you can scream and yell a whole lot, but you can't come back out on the field. You got to pick somebody else to be the quarterback. The parents just aren't good teachers. They're not good coaches, and they need to learn how to coach their children to run the company. Let them get hit once in a while, but just don't lose the game.
Right.
So we need to, the co-ops, if they can, help educate the older generation on what they need to be doing for the next generation to take over.
Yeah, that's good.
That's all part of it.
Sure. The question coming in is, and thank you for that, Gary. I think that's pretty, it's prescient information for the folks on the line and just the community in general. Question coming in is, are there any significant differences in these types of strategies when selling into an adjacent category? The example is an office product dealer buys a janitorial sanitation distributor. The assumption is that this falls into the standard acquisition option. Within this co-op's particular industry, there is a blurring of lines in the industries. So I'll open that up to either of you.
Yeah, I've seen that, but from a valuation standpoint, there's two separate valuation techniques. You can't use the same cap rate or the same multiplier for those two different divisions. You talked about, what was the example you used, Brian? A cleaning company was purchased by what?
Office product dealers.
I would encourage the office products dealer to thoroughly understand that he's getting into a different industry. There's going to be a different gross margin. There's going to be different advertising rules. There's going to be different vendors. So they need to go into this with their eyes wide open. It may sound like they go together, and they do kind of go together, but the multiples and the cap rates are going to be different. Their annual expenses are going to be different, and that's very important. Protecting their gross margin and minimizing expenses is very important to any business. But if they're going to buy a cleaning company, they need to understand that the cap rates are different and the expenses are different and the vendors are different.
Yep.
And you may also want just to think a little bit differently about the contract that you might want to keep in place with the outgoing seller, in this case the seller of the janitorial business, to help make sure that the office supply business that's acquiring the different company has access to the knowledge about the industry that's in the brain of the janitorial company selling owner.
The last thing I would add is if they do buy another company, a separate type of company, is to keep two sets of books so that you can analyze the gross income and the profitability of each company. Don't mix it all into one checkbook. Make sure your accountant set up separate ledgers.
That's good. Another question here, is there a sector that seems to be, like of the ones that you've worked with, a sector or industry that seems to be the most primed for succession planning? Is it like, is there kind of benchmarks that one industry could compare to another, just using the office products versus maybe janitorial or construction, roofing versus drywall, something like that? Is there a sector that seems to be adopting the succession planning mantra quicker than others?
Allison, you go first.
Yeah, I don't know that I've seen it sector specific, but I have seen it purchasing co-op specific. So, you know, different purchasing co-ops have taken on this mantle, to use the word in the question, you know, kind of more aggressively or less aggressively than others. And I think you see that, you know, you see the approach to education, the approach to member engagement around these issues can really influence what happens among the member companies. And so that's why we're really stressing the need for that education and the need for that member engagement, and, you know, being thoughtful about it, because it can really influence what happens to your members and how they're retained within the purchasing co-op.
This is Gary. I guess I would add that what I've seen in the older co-ops, for example, the hardware industry, the floor covering industry, the industrial tools industry, all of those industries have been around for 30, 40, 50 years, 100, or not 100, but maybe 60 or 70 years. And the older co-ops have older members. And they're the ones that are desperately trying to figure out how to protect their membership, how to protect their purchasing power of the co-op. And they're investing, the bigger ones that have 3, 4, 5,000 members or more, they'll designate 2 or 3 people to help members, and we work with them a lot on helping members to understand what their options are, to educate members. For the smaller co-ops that have older members, that have maybe 3, 4, 500 members, the president or a couple of the board members will try to communicate with the older members around the country. You know, so for example, in Nebraska, they know who might want to sell and who might be a buyer, or Texas, you know, or Virginia. Keeping track of buyers and sellers is something that a lot of the co-op presidents are doing, because a lot of the members will naturally talk to the president of their co-op and confidentially talk about, gee, I'd like to buy, or gee, I'd like to sell. So sometimes it's the co-op president that keeps a yellow piece of paper in his office and in his desk, and he writes down buyers on one side and sellers on the other, which is the kind of information that we desperately need if we're working with a bunch of members. So for smaller groups, it's usually the president. For larger groups, they designate 2 or 3 people, but they are doing all of this stuff, and they're all trying to make sure that they do everything they can to work with members. One of the things that has been happening the last 2 years is a lot of the co-ops will send out an email or a questionnaire to their members, and they'll say, please tell us, do you want to retire, or do you want to sell, or do you want to develop a succession plan in 0 to 1 years, or 1 to 3 years, or 3 to 5 years? So that, and do you want to sell to your children, or you want to sell to somebody else at the co-op? And if they can ask maybe 3 questions, they'll know out of their members how many are going to be wanting to make a transition in the next 1, 2, or 3 years, which is very important information for any co-op president. But asking the members what they think they want to do is becoming something that several different people have already done. Find out who wants to sell in the next 1 or 2 years, and they've really got to work with those members right away.
Right. Good. Well, we're a couple minutes past our time here. If anyone else has any questions, please feel free to email me after this webinar. I'll make sure that Gary and Allison have a chance to address those. We want to thank everybody, you know, that's on the line, that's had to leave. I wanted to thank everybody for attending. The webinar has been recorded, so you'll receive that link, as I mentioned, tomorrow, and we'll try to get that posted up on the NCBA site shortly thereafter. If you're looking for more information on purchasing cooperatives, you obviously can feel free to contact me. My information is, and Gary's and Allison's, is available on this slide. And I encourage you to subscribe to NCBA CLUSA's Co-op Weekly. It's an e-newsletter. That's where we'll be posting the dates for the second and third webinars in the series. We'll also be running a kind of a webinar season that will address the top challenges that our purchasing cooperatives have listed. We'll be using those webinars to build out our conference workshops and master classes that we'll be offering. If you have questions about those, or you want to get more information about the conference, again, email me. I'm here to help. It's been my pleasure to moderate today's webinar. Gary and Allison, you guys are fantastic, and thank you for helping prepare all this information. If there's nothing else, we'll end the webinar here, and Gary and Allison, we can circle up on a phone call to sort of recap everything. And I just want to thank everyone else for staying on the line, and enjoy the rest of your day.
Yes. Thank you, Brian. And Allison, thank you. And I have enjoyed talking to everybody that was listening.
Yeah, thanks, everyone.
Thanks. Gary, Allison, I'll give you guys a shout, conference line after this on your cell phones. Thanks.
Thank you.